Welcome to Equity Axis. I'm Respect.
And I'm Tinashe.
In this show, we are looking at the stock market performance in the current week. The stock market has been seeing good times, and the stock market is up 47% year to date, having gained 35.8% in the first 6 months of the year. In the current week, the stock market earned 1.2%, which was driven by gains in mid-tier stocks like MedTech, and also companies which released results in the current week, including Barclays and Dairybot. What do you make of the current stock market rally?
Respect, the rally is really worrying, especially for businesses and investors. I really think this rally is not being supported, by fundamentals. It's just being driven by sentiments. People, they are running away from risks in the money market and trying to find cover in real assets. Your stocks.
But what do you mean when you
properties.
refer to it as fundamentals? What do you mean by that?
If you are looking at stocks, what shapes them is really the company performances.
Sure.
The performances of these share prices and even this bull run of the ZSE. It's not mirroring, the listed companies' performances. Listed companies' performances, they are really struggling and taking a clue from, this underperforming economy. So I think, it's just, risky aversion, investors running away from, your money markets and riskier assets to safe haven.
Yeah, but when you're talking to some stockbrokers and asset managers, they would want to argue that basically the local market has historically been undervalued, and maybe a rebound mirrors that closing of the gap, the undervaluation gap. But personally, I do concur. The market has really gone up to dizzy heights, and people are becoming more and more averse. They're looking at the money market and they're seeing the bond notes released. We have got another 300 million tranche coming along the way. I want to believe that increases the allure of alternative assets. Yeah. But we haven't really seen this similar upsurge in the property market, because when people are running from monetary assets, they're going to real assets, which is equities and properties. But now properties, they remain low in terms of their yields. But then equities has really seen some very good times. To what extent do you believe this rally is going to keep going up?
I think the rally will continue as long as, these risks still remains. Your bond notes continue to depress the rates in the money market, and even, these negative sentiments about, towards an election year, people tend to be skeptical and trying to take cover from, your equities.
But what similarities can we draw from the 2013 rally? We saw a 2013 rally before elections. The market started picking up. We reached a high of 232. But personally, when I'm looking at these two scenarios, I'm looking at 2013, where the market saw an opportunity of probably a change in the government of sort. Whereas in 2017, pundits are putting their money against the opposition. In a way, I want to believe the 2017 rally is mirroring more on the risk that the market may accrue, given that we are moving towards money.
If you want to try to compare your 2013 vis-a-vis this current year, I think currently the risk is they've intensified. You have bond notes, you have foreign payments challenges, we have forex shortages, which wasn't the same with 2013. So I feel this rally it's a function of all these risks and everything that's happening in the economy.
Where I believe we are on the same side. We are saying it's about risks. Yeah. I'm saying 2013 was not more about risk. Yeah. It was more about confidence.
Yes.
Just when the election results were announced, the market crashed.
No.
We lost about 10% in value, which was almost about 1 billion in those in the aftermath of the 2013 election, which shows the expectations, the shortfall in expectations, which led the market
but
to
don't
come
you think
down.
the same might happen in the coming year after election and results announcement?
I want to believe it's a function of the background. What would have inspired the rally? The rally in the current term does not, it's not checking the temperatures of whoever is going to take power. It's just taking coup on what the money market is offering, which I want to believe, of course, is government related, because this is paper being issued by the central bank on behalf of the government. But all the same, I want to believe it's just a matter of the inherent risks that are associated with various market instruments.
Yeah, I agree with you there. I think, the whole rally is a result of, limited investment options. If you've got your money, your $100 in Zimbabwe, you've got actually limited options to invest in. If you go to the money market, depressed interest rates, treasury bills, they have flooded the market. Then you also go, even the property market is soft. It's not that lucrative because property yields, they are coming down. Rentals, they are coming down. They are being revised downwards. So I think the stock market is the only viable investment options. And even these limited withdrawals as well, as a result of, foreign payments challenges. And even the challenges that we have in terms of investing in other markets as well. There are controls in terms of capital outflows in this country. So I think institutions and even potential investors in this economy, they don't have options but just being stuck on the stock market.
We expect the stock market to keep rallying into 2018, but we, however, note that fundamentals are still amiss. This was your ZSC Weekly Roundup with us, Equity Access.